No, I'm not going to fire him. I'm just disappointed at the clip. I think it's far too fast, far too rigid, far too fast.
All right. This time the president not a fan of what the Federal Reserve is doing to sort of rein on his party, which has been an economic boom, he says. Now, that's a little bit different than what he was saying around this time back in 2016 when he was running for president of the United States. Take a listen.
They're keeping the rates artificially low so the economy doesn't go down, so that Obama can say he did a good job. That's the only reason that the rates are so low. So they're keeping the rates artificially low so Obama can, go out, play golf after January and say that he did a good job. But it's a very false economy. We have a false economy.
All right. His argument then as a candidate for the presidency of the United States was that the Federal Reserve was orchestrating a sort of a rigged economy, that rates should have been much higher, that they were beyond their norm. He was right then, but he is arguing that for the Federal Reserve to get back to a norm now, it's wrong. The former Reagan budget director, David Stockman, who kind of agrees with the Federal Reserve and how it can sort of rig things, but maybe in this case going too far? What do you think?
Well, I think he was right the first time, and he's out to lunch this time. He called it one big, fat, ugly bubble. That was true in the fall of 2016. It's 40% bigger now. It's an even more egregious bubble. This isn't a sustainable market. We're getting a little bit of a wake-up call, but there's a lot more to go over time.
When you say a lot more to go, what do you mean?
Well, I think the market is way, way overvalued. We're at month 112 of a business expansion, the second longest in history, 6 months from the longest ever. And there's no way.
We also came from the worst recession since the Depression.
Well, the worst, but we've had the weakest recovery as well. This economy has not invested. The money's just flowed into Wall Street. We've had huge amount of financial engineering.
So the Federal Reserve, if you buy the president's argument, should have been raising rates right after that period of the precarious period, right after the meltdown when it was keeping rates low. It ended up keeping them very low, near zero for 8 years. That was too long.
That was a huge mistake.
He just doesn't like it happening under his watch.
But we're still there. Inflation has gone up. When he said that, inflation was running 1.5%.
Right.
The funds rate was about 1.5%. It was still negative in real terms.
The funds rate, federal funds is the bank overnight lending rate.
Yeah.
Now it's getting closer to an equilibrium. But to be fair, it's at 2.5 now. It should really be to keep with norms around 5%, right?
Of course. I mean, today the inflation rate came in at 2.4% year over year. The funds rate is 2.13. We're still underwater. 8 years negative real money market rates. That is the biggest incentive for speculation and for bubble building on Wall Street that you can imagine.
Where's the bubble? A lot of people look at it and they really didn't see the bubble like there was, let's say, prior to the internet bust.
It's even worse.
Where do you see it worse?
We'll take Amazon. If you set aside AWS, the cloud service, basically it has $1 billion worth of income, and the rest of Amazon, the e-commerce, is valued at $700 billion. It was a few days ago. That's 700 times earnings.
But you could also look at its aggregate multiples and say that it isn't rich and that it's gotten decidedly more affordable now. You think that it has a crash level to go?
Oh, of course. Amazon is absurdly valued. So is Netflix. So is the whole Nasdaq 100. Let me give you a number. It's been 11 years since the pre-crisis peak in November 2007. 11 years. During that period, Nasdaq 100's up 200%, even after inflation. How much is labor hours up in our economy? 6%. How much is industrial production up? 2%. How much is median real family income up? 0. How much is manufacturing up in 11 years? It's down 3%. Now, you can't have an economy on Main Street going nowhere and a stock market going up 200%.